Peter, we were surprised to hear the news over the weekend that OPEC planned to cut production in terms of their global oil output. And one of the immediate concerns that I think many of us had is what type of impact that would have on inflation and what the Fed continues to have to juggle. What are your thoughts on this cut and how it could impact inflation throughout the rest of 23 here?
So yeah, that's the primary issue right now. So yeah, I mean they're going to cut back. It says about maybe about a million barrels a day. Now, the immediate impact on that on gasoline should be, we think, maybe from 10 to 25 cents per gallon for regular. Now, depending upon how long those rates are, those cuts go on for, and what the price reaction is on a barrel of oil, we may see different effects on say CPI. So we think if the increase is as much as say $20, which would bring the price of West Texas Intermediate to about $100 a barrel, that would add between a half and a full percent to CPI. So currently with CPI core at about 5.5%, headline 6%, we believe that would bring CPI to maybe 6.5% or so. The issue is what, of course, as you mentioned, the Fed will do, because right now the Fed is in a bit of a tight spot. With the weakness in the banking sector, they probably don't want to raise rates much more. And if they do lower rates to address the banking issues, then we could see prices, which have come down a bit since last July, rise even more.
Certainly. In your thoughts just on with the oil increase that we'd see here from a pricing perspective, the other thing that can play into CPI is just consumer expectations for inflation. And we've often talked about how just the psychology behind seeing those higher prices at the pump almost makes inflation just persist on even longer in the minds of consumers. With that half-point estimate increase that you've put in there, does that incorporate some of that thought process that consumers could really have this built-in idea that inflation is really here and much more persistent than they thought previously?
So I think that what we see of consumer expectations and inflation expectations is going to have a bigger impact on what the Fed does than the actual price increases. So let's say we did have an increase owing to the rise in the price of oil, of inflation. Let's go again to CPI from, say, in the 6.5% area. That won't necessarily make the Fed do anything, but if we see that the inflation expectations, which have been falling for some time, were to rise decisively, that would spur the Fed to act. I think that would make the Fed have to make good on their promise that they're focused right now more on inflation than on, say, financial stability and some of these other issues. And by the way, the financial stability issues are being a little bit overblown. We had two banks, really two or three banks that had serious troubles. Credit Suisse was a different situation. Deutsche Bank was never really in any trouble. So I think those problems are addressed. So I think the Fed can focus right now on price stability, but it's a good point. Expectations are more likely to drive the Fed to act than actual small price changes.
Yeah, you would just hope that perhaps as we get further and further away from, I won't call it a banking crisis because that's overstating the impact, but we get further and further away from the Silicon Valley Bank issues, that the Fed can kind of get back on course. But to your point, if CPI were to jump by that 0.5% and get closer to 6%, it would put a tremendous amount of pressure on the Fed to really be more aggressive with their rate hikes, which you had mentioned before they're not too comfortable with. Do you foresee a situation? I know it's impossible to gauge what the Fed is going to do because they're trying to digest reports as they come out, but do you see a situation where they could have to be more aggressive later in the year in terms of hikes because of, a potential impact from OPEC's cut here?
Yeah, so I think if, let's say we had an increase, unlikely though it is, or there could be a confluence of factors. Let's say we had an increase in the West Texas Intermediate price to the levels we saw right after Russia invaded Ukraine last year, of say $120, $125 a barrel. If we had that, and then we had high inflation expectations, and then some of the prices like rents and all that did not go down, yeah, we could see another 50 basis point cut later in the year. 50 basis point hike later in the year.
Certainly. Anything else that you're going to be monitoring here over the next couple of weeks, Peter, in terms of economic data that comes out, or just from a general economy's perspective?
Yeah, well, yesterday we had ISM manufacturing, and that was weak. And today we had factory orders, and those were weak too. So, we're still seeing a slow contraction of the economy. It's too early to call recession or not, but I think the overall picture is that the economy is slowing. I think what we should be looking right now is what happens in employment, because employment is still strong, but it's more and more narrow in areas like education and medical jobs. So that, I think, is going to be the area that will force the Fed's hand if the oil situation doesn't take precedent.
Certainly not an easy job for them. I'm glad I don't sit in their seats. That's Peter Earle from the American Institute for Economic Research talking to us about OPEC's cut. Peter, thanks so much for the time today.